Hey everyone, welcome back to the channel. Great to have you here for round 3 of our EA exam part 1 prep series. This is our third mini test on enrolled agent exam, part 1. Individuals 2026-27, still under domain 1. Preliminary work and taxpayer data. In our previous sessions, we covered items, filing deadlines, and basic penalty rules. Today's 20 questions dive deeper into estimated tax safe harbor rules for high income taxpayers, underpayment penalties, special provisions for farmers and fishermen, filing thresholds for dependents and church employees, backup withholding rates, and relief provisions like innocent spouse relief and injured spouse allocation. These are detailed, calculation heavy topics that the EA exam loves to test. So stay focused. As always, don't just sit back and listen. Pause after each question and its options. Work through it yourself and then check your answer against mine. That's the real way to test your preparation. Alright, enough talking. Let's dive right into question 41. Question 41. What is the estimated tax safe harbor requirement based on the prior year's tax liability for high income taxpayers? Adjusted gross income over $150,000 or $75,000 if married filing separately. A 90% of the previous year's tax. B. 100% of the previous year's tax. C. 110% of the previous year's tax. D. 125% of the previous year's tax. The correct answer is C. 110% of the previous year's tax. For high income taxpayers, AGI over $150,000 or $75,000. If MFS, the safe harbor rule based on the prior year's tax liability is adjusted from 100% to 110%. Great. Now let's move to our next question. Question 42. Here's the scenario. In 2025, Felix had an adjusted gross income AGI of $115,000 and a total tax liability of $9,500, which was fully covered by his paycheck withholding. In early 2026, Felix starts a lucrative consulting business on the side and he reasonably estimates that his total tax liability for 2026 will increase to $16,000. To guarantee he avoids an underpayment penalty for the 2026 tax year using the prior year safe harbor rule, what is the minimum total amount of tax Felix must pay throughout 2026 via withholding and estimated payments? A. $16,000, B. $14,400, C. $10,450, D. $9,500. The correct answer is D. $9,500. Under IRS safe harbor rules, a taxpayer can avoid the penalty for underpayment of estimated tax if their timely payments through withholding and estimated quarterly payments equal at least 90% of their current year's tax liability or 100% of their prior year's tax liability, whichever is smaller. Because Felix's prior year AGI was not over $150,000, $75,000 if married filing separately, he qualifies to use the standard 100% prior year safe harbor by ensuring he pays exactly $9,500, 100% of his 2025 tax liability, evenly throughout 2026. He will successfully avoid any underpayment penalties, regardless of how high his actual 2026 tax liability ultimately becomes. Great. Now let's move to our next question. Question 43. Below what threshold of total tax liability, after subtracting withholdings and credits, is a taxpayer exempt from the underpayment of estimated tax penalty? A. $400, B. $500. C. $1,000. D. $2,000. The correct answer is C. $1,000. Under the $1,000 rule, a taxpayer will not face an underpayment penalty if the total tax liability on their return, minus the amounts of tax credits or paid through withholding, is less than $1,000. Great job so far. Let's keep the momentum going with question 44. Question 44. Here's the scenario. In 2025, Brenda works full time as a hospital administrator and runs a small side business as a freelance photographer. She did not make any quarterly estimated tax payments during the year, relying entirely on the W 2 withholding from her full time job to cover her total tax liability. When Brenda prepares her 2025 tax return, she calculates her total tax liability to be $18,850 and her total W 2 withholding to be $18,000, leaving her with a remaining balance due of $850. She e-files and pays the $850 balance in full on April 15th, 2026. What is the amount of the estimated tax underpayment penalty Brenda will owe? A. $42. B. $0. C. $85. D. $850. The correct answer is B. $0. For the 2025 tax year, the IRS provides a specific safe harbor that exempts a taxpayer from the estimated tax underpayment penalty if their total tax balance due, after subtracting withholding and refundable credits, is less than $1,000. Because Brenda's remaining tax liability at the time of filing is only $850, she falls well below this statutory threshold. Therefore, even though she earned self employment income and made no quarterly estimated payments, she will not be assessed an underpayment penalty as long as she pays the remaining $850 balance by the standard April 15th filing deadline. Fantastic. Let's move on to question 45. Question 45. Which form is used by taxpayers to calculate an estimated tax penalty or to request a waiver of the penalty? A. Form 1040X, B. Form 4868, C. Form 2210, D. Form 8857. The correct answer is C. Form 2210. Taxpayers use Form 2210, underpayment of estimated tax by individuals, estates, and trusts, to calculate an estimated tax penalty or to request a waiver of the penalty. Perfect. Let's move ahead to question 46. Question 46. Here's the scenario. In 2024, Cameron, a 28-year-old single US citizen, earned $4,500 from a temporary retail job. Because his income was below the standard deduction, he had zero tax liability and did not file a 2024 tax return. In 2025, Cameron started a lucrative freelance web development business but made no quarterly estimated tax payments. When he prepares his 2025 tax return in March 2026, he discovers he owes a total of $6,800 in taxes. Assuming Cameron pays the $6,800 balance in full by the April 15th, 2026 deadline, what is the amount of the estimated tax underpayment penalty he will be assessed for the 2025 tax year? A. $680, B. $340, C. $0, D. $6,800. The correct answer is C, $0. Under IRS rules, a taxpayer is entirely exempt from the underpayment of estimated tax penalty if they meet all three conditions of the zero tax liability exception. They had no tax liability for the prior year. They were a US citizen or resident alien for the entire year, and their prior tax year covered a full 12-month period. Because Cameron had zero tax liability in 2024, he safely qualifies for this exception. Even though he owes a substantial $6,800 tax balance for 2025 and made no estimated payments during the year, he will not incur any underpayment penalty as long as he pays the total amount due by the standard tax filing deadline. Great, let's continue to question 47. Question 47. Under special rules for qualified farmers and fishermen, by what date must they file their return and pay all tax owed to entirely avoid making estimated tax payments? A. January 15th of the following year. B. March 1st of the following year. C. April 15th of the following year. D. June 15th of the following year. The correct answer is B. March 1st of the following year. Qualified farmers and fishermen do not have to pay estimated tax if they file their return and pay all tax owed by the first day of the third month after the end of the tax year, which is generally March 1st. Great. Moving on to question 48. Question 48. Here's the scenario. In 2024, Victor, a single taxpayer, reported an adjusted gross income AGI of $190,000 and a total tax liability of $32,000. In 2025, his business expands significantly and he reasonably estimates his 2025 AGI will exceed $500,000. To guarantee he avoids the estimated tax underpayment penalty for the 2025 tax year using the prior year safe harbor rule, what is the minimum total amount of estimated tax Victor must pay evenly throughout the year? A. $32,000, B. $35,200, C. $28,800, D. $38,400. The correct answer is B. $35,200. Under standard IRS rules, a taxpayer can avoid the underpayment of estimated tax penalty by paying either 90% of the current year's tax liability or 100% of the prior year's tax liability. However, a special rule applies to high income taxpayers. If a taxpayer's adjusted gross income AGI for the prior year exceeded $150,000, $75,000 if married filing separately, they cannot use the 100% safe harbor. Instead, they must pay at least 110% of their prior year tax liability. Because Victor's 2024 AGI of $190,000 was well above the $150,000 threshold, he must pay 110% of his $32,000 prior year tax liability. By making timely estimated payments totaling $35,200, 110% multiplied by $32,000, Victor successfully meets the safe harbor requirement and will not incur an underpayment penalty, regardless of how high his actual 2025 tax liability ultimately becomes. Awesome, let's move to question 49. Question 49. What is the current backup withholding rate for US citizens and legal US residents who fail to provide a correct taxpayer identification number? A. 15%, B. 20%, C. 24%, D. 30%. The correct answer is C, 24%. The current backup withholding rate for US citizens and legal US residents is 24%. Great. Let's move forward to question 50. Question 50. Here's the scenario. In 2025, Harrison operates a self employed catering business in Ohio. Historically, his income is steady and he makes equal quarterly estimated tax payments of $800. However, in late December 2025, Harrison caters a massive corporate holiday event, earning a sudden lump sum that significantly increases his total tax liability for the year. He plans to make a much larger final estimated payment for the fourth quarter, but he wants to avoid being penalized by the IRS for underpaying in the first three quarters. Which of the following methods should Harrison use to report this income variance and avoid the penalty? A. Submit Form 1040 ES with an attached penalty waiver request. B. Request a standard first time penalty abatement over the phone. C. Pay the Q4 estimate early and attach a written explanation to Form 1040. D. File Form 2210 using the annualized income installment method. The correct answer is D. File Form 2210 using the annualized income installment method. The IRS generally expects taxpayers to pay their tax liability evenly throughout the year, either through withholding or equal quarterly estimated payments. When a self employed individual experiences a significant spike in income late in the year, the standard penalty calculation assumes that total income was earned evenly all year, which can unfairly trigger an underpayment penalty for the earlier quarters. To resolve this, the taxpayer must file Form 2210, Underpayment of Estimated Tax by Individuals, Estates and Trusts, and elect the annualized income installment method. This method calculates the required estimated tax due based on the actual income received in each specific period, safely preventing penalties for the earlier quarters when his actual income and required payments were genuinely lower. Fantastic. Let's move on to question 51. Question 51. At what amount of net earnings from self employment is a taxpayer strictly required to file a federal income tax return, regardless of their total gross income? A. $108.28. B. $400. C. $600. D. $1,000. The correct answer is B. $400. A taxpayer is required to file a tax return if they have net earnings from self employment of at least $400, regardless of their total gross income. Great, let's continue to question 52. Question 52. Here's the scenario. Beatrice is the sole proprietor of a commercial cranberry bog in Massachusetts, and 100% of her gross income comes from farming. She typically avoids making quarterly estimated tax payments by filing her Schedule F and paying her entire tax liability by the special March 1st deadline each year. However, due to a severe winter storm, Beatrice's financial records for the 2025 tax year are delayed, and she realizes she will not be able to file her return and pay her taxes by March 1st, 2026. By what date must Beatrice make a single estimated tax payment to avoid an underpayment penalty for the 2025 tax year? A. December 31st, 2025. B. March 1st, 2026. C. January 15th, 2026. D. April 15th, 2026. The correct answer is C. January 15th, 2026. Under IRS rules, qualified farmers and fishermen, individuals who receive at least two-thirds of their gross income from farming or fishing, are exempt from making standard quarterly estimated tax payments, provided they file their income tax return and pay the entire tax due by March 1st of the following year. If a qualifying farmer like Beatrice cannot meet this special March 1st deadline, the safe harbor provision requires them to make a single estimated tax payment by January 15th of the following year. In this case, January 15th, 2026 for the 2025 tax year to successfully avoid an estimated tax underpayment penalty. Excellent. Let's move on to question 53. Question 53. At what amount of income is a church employee strictly required to file a federal income tax return? A. $108.28 or more. B. $400 or more. C. $600 or more. D. $1,300 or more. The correct answer is A. $108.28 or more. Taxpayers must file a federal tax return if they earn $108.28 or more as a church employee, an employee of a church or religious organization exempt from employer social security and Medicare taxes. Great. Let's move to question 54. Question 54. Here's the scenario. Silas operates a commercial apple orchard in Michigan, which provides 100% of his gross income. He did not make any quarterly estimated tax payments during the 2025 tax year. To completely avoid the penalty for underpayment of estimated tax for 2025, by what statutory date must Silas file his tax return and pay his entire tax liability in full? A. March 1st, 2026. B. January 15th, 2026. C. April 15th, 2026. D. December 31st, 2025. The correct answer is A. March 1st, 2026. Under IRS rules, individuals who qualify as farmers or fishermen, meaning at least two-thirds of their gross income for the current or prior year comes from farming or fishing, are granted a special exception regarding estimated taxes. They are completely exempt from the requirement to make quarterly estimated tax payments if they choose to file their annual Form 1040 and pay 100% of the tax due by March 1st of the following year. By meeting this March 1st, 2026 deadline for his 2025 tax return, Silas safely bypasses any estimated tax underpayment penalties despite making no prior payments. Great! Let's move on to question 55. Question 55. What is the threshold amount of unearned income that generally triggers a filing requirement for a dependent child in 2025? A. Greater than $400. B. Greater than $1,350. C. Greater than $2,600. D. Greater than $14,600. The correct answer is B. Greater than $1,350. A dependent child with only unearned income, such as interest or dividends, must generally file a tax return in 2025 if their unearned income is greater than $1,350. Great, let's continue to question 56. Alright, we're deep into some tricky territory now. Farmers, fishermen, estimated tax exceptions. This stuff can get confusing, I know. Honestly, these are exactly the kind of topics where just watching a video once isn't enough. You really need to sit with the numbers, Work through a few more examples yourself and let the concept sink in properly. That's something I always tell my students. If a topic feels shaky, don't move on until you've practiced it a few more times in different scenarios. Alright, with that said, let's get back into it. On to question 56. Question 56. Here's the scenario. In 2025, Declan reports a total gross income of $120,000, which consists of profits from his commercial vegetable farm and a separate freelance copywriting business. Under IRS rules, what is the minimum amount of gross income that must be derived specifically from the vegetable farm for Declan to qualify for the special estimated tax exception for farmers? A. $60,000, B. $80,000, C. $90,000, D. $120,000. The correct answer is B. $80,000. To qualify for the special estimated tax rules for farmers, which permits a taxpayer to bypass standard quarterly estimated payments if they file their return and pay the total tax due by March 1st of the following year, at least two-thirds, 66.67% of the individual's total gross income for the current or prior tax year must come from farming activities. Because Declan's total gross income for 2025 is $120,000, he must earn a minimum of $80,000, two-thirds of $120,000, from his farming business to be considered a qualified farmer. If his farming income falls below this threshold, he is not eligible for the exception and must make regular quarterly estimated tax payments throughout the year to avoid an underpayment penalty. Excellent. Let's move on to question 57. Question 57. Here's the scenario. In 2025, Zachary visits a casino in Atlantic City and wins $25,000 on a slot machine. When the casino floor manager requests Zachary's social security number to process his payout and issue the required tax forms, Zachary refuses to provide it due to identity theft concerns. Because he refused to provide his taxpayer identification number, what percentage of backup withholding is the casino legally required to apply to Zachary's winnings? A. 24%, B. 20%, C. 28%, D. 30%. The correct answer is A. 24%. Under IRS rules for the 2025 tax year, if a taxpayer receives reportable gambling winnings, such as $1,200 or more from a slot machine, but fails or refuses to furnish a correct taxpayer identification number TIN or Social Security number SSN to the payer, the winnings immediately become subject to backup withholding. The mandated backup withholding rate is 24%. The casino must withhold 24% of Zachary's total payout, remit those funds to the IRS, and issue him a Form W-2G that reports both the gross winnings and the federal income tax withheld, which Zachary can later claim as a tax payment when he files his annual income tax return. Great, let's move to question 58. Question 58. Which form is used to request innocent spouse relief, separation of liability relief, or equitable relief? A. Form 8379, B. Form 8857, C. Form 1040X, D. Form 2210. The correct answer is B. Form 8857. Form 8857, Request for Innocent Spouse Relief, is the uniform form used to request innocent spouse relief separation of liability relief, and equitable relief. Great. Let's continue to question 59. Question 59. Here's the scenario. In 2025, Wesley holds several investment accounts with Horizon Wealth Management. The IRS notifies Horizon Wealth that the social security number attached to Wesley's account is incorrect. Despite receiving multiple written requests from his broker to update his information with a certified W-9, Wesley fails to respond. Consequently, Horizon Wealth must begin backup withholding on his future dividend and interest payments. What percentage must the brokerage withhold from Wesley's investment income for federal taxes? A. 15%, B. 24%, C. 28%, D. 30%. The correct answer is B. 24%. Under IRS rules for the 2025 tax year, payers such as banks and brokerage firms are legally required to initiate backup withholding on certain types of income, including interest and dividends. If the taxpayer fails to provide a correct taxpayer identification number (TIN), or if the IRS issues a notice that the provided TIN is incorrect. When triggered, the mandatory federal backup withholding rate is a flat 24%. Horizon Wealth Management must withhold 24% of Wesley's reportable investment income and remit it to the IRS to ensure the tax liability is covered until Wesley rectifies the issue by providing a correct certified TIN. Excellent. Now let's move to our final question. Question 60. Question 60. Which relief provision should be requested when a joint refund is applied to one spouse's past financial obligations, such as past due student loans or child support, and the other spouse is not responsible for the debt? A. Innocent spouse relief. B. Separation of liability relief. C. Equitable relief. D. Injured spouse allocation. The correct answer is D. Injured spouse allocation. Injured spouse allocation, Form 8379, is filed when a joint tax return is filed and all or part of a refund is applied to one spouse's past due debts, allowing the non responsible spouse to request their portion of the refund. And that brings us to the end of today's mini test. Great job working through all 20 questions on estimated tax safe harbor rules, underpayment penalties, special provisions for farmers and fishermen, filing thresholds, backup withholding, and spousal relief provisions. Now I'd love to hear from you. Drop your score out of 20 in the comments below. And if you've been following along with our previous tests too, let me know your combined progress across all sessions. Before I let you go, if any of today's topics felt a little overwhelming, that's completely normal. This is dense material. I do have a complete practice resource with over 1,000 questions covering every chapter in detail in case you ever want extra material to work through at your own pace. You'll find it linked below if it's ever useful to you. If today's session helped you, do hit that like button and make sure you're subscribed so you don't miss our upcoming domain wise tests. Keep showing up, keep practicing. I'll see you in the next mini test. Until then, take care and keep grinding.